All right, let's talk about two giants in the world of things that stick: 3M and H.B. Fuller. Now, on the surface, you'd think they're in the same game, right? Making glue. But if you dig into their financial reports, you find a story that is, well, it's wild. And it totally changes how you look at them. So let's get into it. Okay, check this out. First up, 3M. This number, 68.5%, is their return on equity. What does that mean? It means for every single dollar an owner has in the business, 3M is somehow making almost 69 cents in profit. That is just an insane number. I mean, it's almost too good to be true. And then we have H.B. Fuller. Their return is 7.6%. That's a pretty good, solid number for an industrial company. Totally respectable. It's the kind of number that makes sense. But put an extra 3M, and it just looks tiny. So this is the big question, isn't it? The mystery we're going to solve today. Is 3M actually 9 times better at making money for its owners than H.B. Fuller? The big flashy number on the screen says yes, absolutely. But that number, it's hiding something really important. So let's solve this thing. We're going to pop the hood on these two companies and see what's really going on inside their financial engines. It's time to figure out how they get to these completely different numbers. See, the secret here isn't just about what they sell. It's about how they're built. We can break down that big return number using a really cool method that looks at 3 main levers a company can pull to make its shareholders happy. The first lever is just profit margin. Super simple. For every dollar of product you sell, how many pennies do you actually get to keep in your pocket after you've paid to make it? It's the basic question: is this a profitable business? Second lever is asset turnover. This one tells you how good a company is at using its stuff, its factories, its machines, all the physical things it owns to actually ring up sales. Are you getting a lot of sales bang for your asset buck? And then there's the third lever. This, my friends, is the secret ingredient: financial leverage. This is the other people's money factor. How much are you borrowing to juice the returns for the actual owners? And boom, this table just lays it all out. First, look at profit margin. Okay, 3M is definitely more profitable on each sale, 13% to Fuller's 4.4. Asset turnover, basically identical. They're both just as efficient. But now, look at that financial leverage row. Whoa, that is the smoking gun. H.B. Fuller is using about $2.50 of debt for every dollar of its own money. Totally normal. But 3M, they're using almost $8 of debt. That massive leverage is what's rocketing their return on equity into the stratosphere. Mystery solved. Okay, so now that we've figured out the financial wizardry behind that crazy number, let's look at what these companies actually do every day, because their business philosophies could not be more different. Think of it like this. 3M is this sprawling technology empire. Post-it notes? Sure, but that's just one tiny piece of a massive materials science platform. Their game is to invent core technologies they can spin out into hundreds of industries. H.B. Fuller, though, is a laser-focused specialist. They do one thing: adhesives and sealants. And their strategy is to be the absolute best, the go-to expert in their specific little corners of the market. And you can see this right in their budgets. 3M plows almost 5% of its sales back into R&D. They're hunting for the next huge, game-changing breakthrough. Fuller spends a much more modest 1.8%, and that money is aimed at perfecting formulas for a specific customer's problem. Like creating the perfect glue for a new heart valve, or a sealant that can withstand extreme temperatures on a new jet engine. But here's the catch with H.B. Fuller's super-focused strategy. It creates a massive vulnerability. Look at this. A whopping 75% of the cost of their products is just raw materials. That means their entire business basically rises and falls with the price of oil and natural gas. They are completely tied to the whims of the global commodity markets. So what we have are two completely different playbooks. We've got the highly leveraged, sprawling innovator in 3M and the focused, disciplined specialist in H.B. Fuller. Now, let's talk about the skeletons in their closets, because both of these strategies come with some very, very big risks. For 3M, the risk is a multi-billion-dollar ghost from its past. This number, $18.5 billion, is the estimated cost of all the lawsuits related to their Forever Chemicals and their Combat Arms earplugs. That's billion with a B. It is a giant financial storm cloud that's going to be hanging over them for a very, very long time. H.B. Fuller's risk is just as serious, but it's not coming from a courtroom. It's coming from the market. They spell it out right in their annual report, clear as day. A tiny 1% shift in what they pay for raw materials can vaporize over $12 million from their bottom line. That is living on a razor's edge. So there you have it. These risks are not theoretical. They define the reality for these two companies right now. One is fighting the consequences of its past inventions, while the other is in a constant battle with the volatility of its own supply chain. Two Goliaths facing two very different but very real threats. All right, let's land the plane. We've solved the mystery of that crazy 69% return. We've broken down their different strategies, and we've stared their biggest risks right in the face. It's time to put it all together for the final verdict. Here's the tale of the tape. 3M is, without a doubt, the technology innovator. They are an R&D machine, but they are dragging around the immense weight of those legal bills and a mountain of debt. H.B. Fuller is the classic market specialist. They are the masters of their domain, but they live and die by the price of their supplies. So when you look at 3M, their entire future is basically a high-stakes race. The question is, can their next big invention, whatever it is, in EVs or data centers or biotech, can it generate enough cash fast enough to outrun the massive bills coming due from their past? And the bet for H.B. Fuller is totally different. For them, the question is whether their deep expertise and their super strong customer relationships are enough of a shield. Can they protect their profits when the commodity markets inevitably go crazy? And this really leaves us with one final fascinating question. What's the better strategy for the long haul? Do you bet on high-risk, high-reward innovation that comes with some serious baggage? Or do you bet on focused, disciplined execution, even if it means you're handcuffed to a supply chain you can't control? Honestly, there's no easy answer here. Look, what we've covered today is really just scratching the surface. If you need to truly understand the deep currents that are shaping the entire chemical industry, from feedstock prices to ESG pressures, our full report at HDIN Research has the analysis you're looking for. You can head over to our website or just email our sales team directly to order the full report. Ask for a few free sample pages. See for yourself how our insights can help you navigate this really complex market and give you that decisive edge. Thanks for tuning in.